Welcome to the Airway Roundtable. Today is the 11th of March, 2020, and I have my guest, Mike Valtos from Order Flows back. Welcome, Mike. Nice to have you again. It's always
Yeah,
good to see a good presenter back.
yeah, no, I'm glad to be back. It's an interesting time in the markets. It's literally like every week it seems like, well, what is this week going to bring? And it just seems like it's something new.
Yeah, I got your software, the footprint software, the charts, and I really like it. I'm anxious to learn more, so I'll be here for the whole presentation. I'll just mute myself in case there's any background noise. I don't want to interrupt.
Okay.
But yeah, if you want to share your screen, we can get going.
Yeah, sure. Let me just get it set up here. Okay. Just
I
want to make
see
sure you
it.
can see my screen okay. And make sure
Yep.
I'm showing the right screen.
Using order flow to stay on the right side of the market.
That's right. That's right. It's like I said, it's been an interesting last few weeks with with this coronavirus. I mean, it's literally like every week it's something else. They're trying to hit the traders with, it seems, but it's not something that hasn't happened before, in the sense that extreme market volatility, and for a lot of traders, traders are just getting started in the last 5 years or so or less. It's a new environment for them. But if you're a little bit older, you remember, the 2007, 2008, 2009 financial crisis. Even before that, you had the Russia default. 10 years before that, 10 years before that, you had, the 1987 crash. So it seems to come about every 10 years, some big major market upheaval. And, it shakes out a lot of traders. There's a lot of people that get affected and blow up their account because, that they're not used to these market conditions. They're not used to expanding, their normal risk parameters. And, they just sort of get caught offside just because of the conditions. Not necessarily they're a bad trader, but it's one of those things where, where under normal market conditions, it's, their method of trading is probably fine. But, if you don't recognize that conditions are changing, then, your method of trading for the last 3 or 4 years, is probably going to suffer. You're going to have a bad time. Now, before I begin, just a brief disclaimer. Trading involves risk. We all know that, right? And don't trade with money you can't afford to lose. The best piece of advice is, the markets are there. They've been there for 150 years in the past. Most likely, they're going to be there for another 150 years, unless the world implodes. The markets exist for people to transfer risk, so there's always going to be a market there for trading. Now, just really brief. I know many of you were here last time, with me and Tom about a month ago. For those that weren't here, just a brief disclaimer, brief background on myself. My name is Michael Valtos. I look young in this photo. This was taken a few years back. I cut my hair short so I look younger, but my head is like all gray hair. And I've been in the futures industry since the early 90s. I started on the floor, CME floor, as a runner with Dean Witter. Eventually, I transitioned from the floor to the off the floor trading desk when electronic trading started taking off. And it was literally just, very closed systems. You just had Globex, which was the CME, Project A, which is CBOT, and NYMEX Access, which was the crude oil, the energy markets, as well as gold and silver and copper. And I noticed then back in the mid 90s that everything was going to go electronic, and that's really where I wanted to be. Back then I was, in my early 20s, and home computers were just starting to um, become commonplace. So I really felt that was the future, and fortunately, it was a good decision. After Dean Witter, I joined EDF Man, which is an English trading company, as a global macro trader on their trading desk. Um, After that, I joined Commerzbank, the big German bank, as their licensed Eurex trader. And I traded Bunds, Babel, Schatz, DAX, Euro stocks. This was back in the 90s when a lot of people didn't even know what those were. But it was great because I got to see how trading in those markets related to the U.S. markets, and there was a lot of correlation trading going on. Then I joined Cargill. I spent 4 years there as a trading desk manager on the futures side, and we literally traded every commodity you could think of in the world, both futures as well as cash. They sent me out to Singapore when the exchange in Singapore was closing because they wanted to set up a off the floor trading desk. Then after Cargill, I took about 6 months off, and then I joined JP Morgan. I spent 8 years at JP Morgan as vice president of futures trading. Now, my background, obviously, is futures. I'm from Chicago, where the exchanges are, so that's always been my background. And coming from the floor, I've always been interested in order flow because when you're on the trading floor, you get to see really the flow of the orders coming into the market. Who's buying, who's selling. Electronically, you can't tell. Now, after JP Morgan in 2013, I left and I started order flows about a year or two later. I really took about a year off from the markets, started writing a book on trading, and eventually I came up with the Order Flows Trader software, which Tom mentioned. It's a volume footprint chart, which basically takes the time and sales, all the data, and puts it into an easy to read format. And the charts you're going to see in this presentation are based on my software. Now, people always ask, what's the best way to learn order flow? Well, if you go to YouTube, go to search order flows, which is my company. I've got a couple hundred videos, literally, I think 220 or so videos on order flow. You could go there, you could watch them, you could really learn a lot. I get people saying, hey, I've been watching your videos for a year, and they're where they were a year ago to where they are now is night and day. So how does order flow help you? Well, it's like looking at a map, right? And it puts the market in perspective. If you don't know how to read a map, you're not going to know how to get from point A to point B. And this goes down to the basic of staying on the right side of the market, right? If you're looking at a map, you have to look at it, north, south, east, west. And sometimes people, they sort of get lost in the market. They start drawing all these different trend lines and squiggly lines, and they put this oscillator up and that one up, and all of a sudden, next thing you know, they're completely lost. Go down to the basics. Understand what the market is doing. Is the market rallying or is it selling off? Are we forming a bottom or are we forming a top? Where are we in relation to the high of the day, the low of the day? Where are we relative to the opening price, which is generally unless it's Sunday night, it's generally relative to where the market closed, an hour before. And now we're trading 23 hours a day, basically. So, the open and closing price are generally, I don't want to say there isn't, but generally there isn't much price fluctuation one way or the other that it really matters. So you should, have an idea of where we are in the market. And you got to, once you understand the market structure, where we are, right, then you can start applying the order flow analysis. And what I want to talk about today is two relatively important pieces of order flow, and it's imbalances, specifically multiple imbalances and imbalance reversals. And just really briefly, what is a multiple imbalance? Well, it's when a bar has three or more buying imbalances, right? Or when an up bar has three or more buying imbalances, when a down bar has three or more selling imbalances. Now, most order flow traders, people that look at a footprint chart, are familiar with the term stacked imbalance, which is three or more imbalances stacked neatly on top of each other. And most order flow footprint charts will highlight a stacked imbalance on a chart. But there's a lot of times where you have three or more imbalances, but they're not neatly stacked on top of each other. And many people just sort of, that they're not looking for that. They're not taught to look for that, but it's very important. And I just want to show you, if you can see my chart here, right in the middle, hopefully you can see this red dot here,
Yeah, I
there
can see
is
it.
what's called a stacked buying imbalance, right? So you have three buying imbalances in the bar. Now remember, right, the markets trade in a two-way auction, right? So it's a bid against the offer. And footprint charts, you could decide what imbalance you want to use. Most, the sort of the industry standard is about a 4-to-1 ratio, 4-to-1 more aggressive buying versus aggressive selling. And there are, now again, that's not a line in the sand. You don't have to use 4-to-1. I know some people that are successful using 250% to 1, which is 2.5 to 1. I know other people that swear by 987% Um, I don't know why they don't use 1,000, but I guess it's the fib number, so they like 987%, and they have their whole trading plan built around imbalances, right? Imbalances is one of the basic fundamental pieces of order flow, right? Of understanding what's happening in the market. And yes, it's nice to see stacked buying imbalances or stacked selling imbalances, but if you're just looking for the most obvious things, you're going to be missing other trading opportunities, right? Bars that have multiple imbalances. Now, the order flows trader software, my software, will put a box around bars that also have multiple imbalances. If it's a stacked imbalance, it will put a box around it because there's three imbalances. But it'll also put boxes around bars that have multiple imbalances, which are three or more imbalances that are not neatly stacked on top of each other, right? And as you can see on this chart, right, there's one stacked imbalance, but you have a red bar with multiple selling imbalances. Market went down. A bar here with multiple buying imbalances. Next bar, big red, it started going up, then came down, but then you got your stacked buying imbalance, right? Market went up, followed by 2 bars later, another bar with multiple imbalances. Even later up here, multiple buying imbalances. So again, if you're just looking for stacked imbalances, yes, you will find them, but you're sort of shutting yourself off to other things happening in the market that are just important. People can't say, oh, only stacked buying imbalances are important because they have to be stacked. Well, you're going to miss a lot of trading opportunities just by not looking for bars that have multiple imbalances. Now, where's my cursor here? This is a bar, or sorry, this is a chart with multiple selling imbalances, stacked selling imbalance, right? You got your nice stacked selling imbalance here right as the market is selling off. Well, that's nice, right? This is in the bonds here yesterday. And, the stacked selling imbalance comes in around the 181.28 area, but the bar preceding it is already giving you a clue, right? It's giving you a clue. You got 4 selling imbalances in there. Even earlier, you're seeing bars with multiple selling imbalances. So while you got a bar here with a nice stack selling imbalance, where would you rather get in? A bar earlier or a bar later? Well, I'd rather get in a little bit earlier, knowing that there's already aggressive selling in the market. I don't necessarily, anytime you get into a trade late, it takes away potential profit. And so I'm always looking for clues in the order flow for market direction and multiple imbalances. Bars with multiple imbalances gives me that clue, right? I'm seeing the aggressive selling happening a bar earlier than the people just waiting for a stack selling imbalance. Now, even earlier, about it was about 15 minutes earlier, you're already seeing signs of aggressive selling. You got 2 bars with um, multiple selling imbalances in there. You got a little bit of a pullback. I'm going to talk about these little green arrow and this red arrow. That's an imbalance reversal. But I'm going to talk about that a little bit later. But the key is looking for the signs as early as possible, right? That's why people are enamored with order flows, because it's going to help them see things that otherwise goes unnoticed, right? And again, multiple imbalances is something that is going to give you an edge over other traders, because most traders aren't looking at order flow, let alone looking at imbalances. Okay, now this is Buns this morning, just like an hour ago, and as you can see, the market is selling off. Now, when I say take things in perspective, using a roadmap, right? Where are we? Now, you have a stack selling imbalance here towards the bottom, 835 this morning. Now, where would you rather be selling? After the market sells off or at a higher level? Me, I prefer to look for areas to sell after market's been rallying, not necessarily after market's sold off. And even though this is a nice stack selling imbalance, the market just goes sideways. And I'm going to talk about this a little bit later, looking for signs in the order flow that a trade is not going to work out. Okay. And I'll come back to this slide later, but there's signs in the next two bars, obviously, that this trade isn't going to work out. But you hit your low area here, market goes sideways, starts to rally. What do you have? You have this green bar with 1, 2, 3, 4, 5 buying imbalances in it, right? They're not stacked. You have two stacked here, another two stacked a little bit later, and the other one up here. So if you're just looking for a stacked imbalance, you're going to miss this bar, right? Because there's no stacked imbalance of three imbalances or more. And oftentimes markets come back eventually to a level. Okay. And you can see here, right? Market popped up, came back. Where did it come back to? It came back to these areas where you have the aggressive buying. And what do you have here? You got more aggressive buying coming in. You got one buying imbalance, one against 72. So this is a level of market generated support. These areas where you have buying imbalances, sort of grouped together. In this case, you have this 111 against 44. That's obviously not a stacked buying imbalance, or sorry, not a buying imbalance. If this 44 was against 11, obviously it would kick off a buying imbalance, but it's not. Then you'd have a nice stacked buying imbalance, and the market came right back there and tested it, and then went back up. But again, if you're looking for a stacked imbalances, you're only going to see the stack selling imbalance. Traders get excited. Oh, I got a stack selling imbalance. I got to get short. Well, put it in perspective of what's happening in the market. Market's been selling off. Is it prudent to take a short? Most likely not. Can the market go down? Of course it can. But for me, I prefer to get short off of rallies, as the market is turning, or get long after the market sells off and starts turning up. I'm looking for signs that buyers are coming into the market. If the market's selling off, yeah, I know that sellers are active in the market. Okay, so I would rather look for sells after the market has rallied. I'd rather look for buys after the market has sold off and is starting to turn around. Now, the opposite, I'll say the opposite rather, but let me just reiterate here, right? This market is going up. This is, again, this about 2 hours ago in the bonds this morning. We hit the swing high. What do you have? You got next bar off that high. You got multiple selling imbalances. And again, if you're just looking for a stacked imbalance, you're not going to see it in here because it's not stacked, and you're going to miss this trade. This was, almost, a move from 180, 181.04 area, down to, 180.20s. Okay. And again, people don't look for this in the market. If you're using a normal bar chart, you're not going to see the imbalances. You're just not. And that's one of the benefits of using order flow. Because if you can see areas where aggressive sellers are really active, or areas where aggressive buyers are really active, that's going to give you the advantage over them, right? It's the way I describe it to people is, if you play cards, if you play poker, it's like being able to see everybody else's hand at once, and that's what's going to give you the edge. Imagine you're playing cards with somebody and you can see their cards, you can see what they're holding, what they're potentially going to do based on their cards. And that's what order flow allows you to do, is that's what the footprint allows you to see. Now, the second part that I want to talk about is an imbalance reversal. And in a very basic sense, it's a form of trap traders, people who sold at or near the low of an up bar, or at or near the high of a down bar, combined with aggressive trading in the direction of the bar as the bar reverses and leaves those traders stuck. And it's easier to show it on a footprint chart. And again, my software will draw these little arrows here. You'll see you can differentiate, light green and dark green. But basically, if you see like these little arrows, it's telling me, there's imbalance of selling at the bottom of this green bar. There's imbalance of selling at this green bar. Now you'll notice there's two different colors. There's a dark green, there's a light green. When I have a light green, it's telling me this bar opened up and there was very aggressive buying very early on. And the thing with aggressive buying, oftentimes, you hear the term market sweep. And what a market sweep is, say the market is, 12 bid at 13. Someone buys it up to 15. They're sweeping the market. They're lifting the 13s, they're lifting the 14s, they're lifting the 15s. They're sweeping through all the offers, just as if they're selling, the market's 12 bid at 13, they sell it down to 10, they turn it offer at 10, they hit all the 12s, all the 11s, all the 10s. They're sweeping through the market. And that leaves a trail in the order flow. You often see very little volume at the bottoms of the bars. And that is, I lump them together as an imbalance reversal, even though it's slightly different than having selling imbalances at the bottom of a green bar or buying imbalances at the top of a red bar. But it's very similar action and it has the same effect on the market. And as you'll see, as the market is moving up, you'll tend to see it leaves a trail of traders trapped at the bottom of green bars, or if the market's moving down, traders trapped at the top of red bars. Now, there's sort of this misconception that when traders are trapped, it's like, oh, there's this big mad rush. No, sometimes it could be a small group of traders, but more importantly, what you want to see is that activity that traders are trapped, or that maybe traders are trapped from a slightly higher level and they just come in and they capitulate and they get out of the market, they sweep through the market. So for example here, right, this is yesterday in the bonds. Okay, so you got your red arrow here. So you can see up here, right, this red candle, you got 116, you're buying imbalance here. You got 127, a selling imbalance. So you hit your swing high, market starts coming off. Next bar opens up. You're trading around here, around the 16 area, the 183.16, and you have aggressive buyers coming in, right? You got, when it was 15 bid at 16, everyone's buying 16s. You know what? We're not going to sell off. Everyone's still interested in buying here, buying 16s. They turn it bid 16. All of a sudden, seller comes in, hits those 16 bid, turns it offered at 16. People are still buying it. Eventually, the people that are buying it are getting stuck, right? They're getting trapped in the market because they're thinking the market's going higher, but there's somebody up there with supply in the market. Markets immediately, once these traders realize that, one, they get out, or two, they stop buying, right? Their buying gets shut off and they're going to wait to see if this market is going to sell off. If it starts selling off, generally they'll start selling. If they think the market's going to come back, maybe they try and scratch it. It really depends. But then the market starts going sideways. It comes off, starts going sideways. We have a bar here with what I call a bearish prominent point of control. That's what this this magenta point of control is. It's telling me there's stopping volume in the market. Again, market started selling off, started rallying when someone shut off the buying that's here, right? Someone's got supply. Then this next bar, it's got a dark red. What's happening as this market's coming down? Someone sweeps through, right? You got 0, 0. So imagine, this market opens up at 03. It's trading 03, 04, doesn't trade fours. You have, it was 3 bid at 4, nothing traded here. Then someone comes in, hits the bid right below it, hits the next bid, hits the next bid, turns it offer. There's no counter trade in here. Again, the sweeping action is often done by, one, someone that was stuck earlier and just wants to get out, or two, somebody that, I don't say has information, but somebody that thinks this market is when I say somebody, I mean a big trader, an institutional trader, somebody that thinks this market is going to go lower, right? Because remember, who moves the market? Generally, it's the big traders. Now, this is the way the e-minis have been. It's been very volatile. So uh, people ask me, well, why do you have all these little indicators on here? Is because sometimes when a market is moving very fast, there's a lot of information, and as you can see here, I wasn't able to fit everything on the chart in a footprint that's easy to read, but I know I have my little tools here, right? I got my green arrows, I've got my red arrows telling me imbalance reversals or sweeping action. And, we're at our low here, right? We got our swing low here. I've got a green arrow, a green arrow. There is one red arrow in here. Again, take things in context of the market. Even if you thought, it was bullish off this first green arrow and you get the red arrow, yeah, you know what, maybe I'll get short, but then it comes right back with the green. Market rallies up. Again, this was a nice 30-point rally. You hit your swing high here, just around 27.98. Red arrow, red arrow. I know there's traders trapped here. I don't necessarily need to look at the actual underlying footprint and analyze the volume. That's what the tools in the order flows trader do. And for many years, I traded order flow using a different tool, right? And there are certain things I'd always look for in the order flow, and this was one of them. One is multiple imbalances, one is imbalance reversals, and I wanted a way for the software to tell me this is happening in the market. And so, I spent some time and I started writing out. It took the initial version of our order flows trader software took about 6 months to develop. I had a guy that already was familiar with order flow and had developed a footprint chart, so he understood it. Put this, put my rules into the software so that we can see this information. And even you can see as this market starts moving up, you got a bar here with multiple imbalances. Again, another bullish sign. So you got the bar here with imbalance reversal, then followed up with a bar with multiple imbalances, and again the market continues its move higher. Now again, I'm not going to get in. You can analyze the delta. This is also very bullish. What's happening in the delta? You can see 505, 903, 1117 as the market keeps moving higher. What that's telling you is that aggressive buyers are in control of the market, right? And not only are they in control of the market with the positive delta, but they're getting stronger, right? The delta is the difference between aggressive buyers and aggressive sellers in a bar. And if you're watching the delta expand, in this case, expand in the positive sense, 505, 903, 1117, you know that aggressive buyers are keep coming into the market. Again, then you hit your swing high. You have some trap traders up here. Next bar, also you got some trap traders here. Next bar, multiple selling imbalance. Market just starts going sideways. You got multiple buying imbalances. This one fails. But again, in the next section, I'm going to tell you why you look for clues in the order flow, why these trades fail. Okay, and that's, to me, that's really a part that gets missed on a lot of traders. Traders think, well, I have a signal, I got to take it. Well, no, you got to watch the order flow, look for signs that the market is going to move in your favor. Now, I always get a chuckle when, sometimes I run across people that say, oh, I discovered the secret method to the market, like that nobody else knows. Okay, fine. Well, the problem with that is, unless you're, a big trader, if nobody else knows to buy at this level and everyone else is selling, the market's not going to go up, right? You may think you go into a cave or something and spend a year there, come out, I found the answer. Well, if nobody else is buying at the same level that you're buying, the market's not going to move up, right? Just as if nobody else is selling after you get short, the market's not going to go down. You need other traders to also, sort of have the same bias as you. And, a lot of people don't really understand that. They think that trading can be solved with, a mathematical formula. Often, again, I don't know, maybe there's some guy in some woodshed someplace, in the mountains that has figured it out, but to the best of my knowledge, nobody has. Now, this is something that this is a very rare occurrence. Okay, I'll say rare, but some markets that are more volatile, you see it a little bit more. On E-mini S&Ps, you very rarely see it. On markets like NASDAQ, mini Dow, crude oil, to a certain extent, you see it. And what this is a form of an imbalance reversal. And what you have here, right, you have this red candle, but at the top of the red candle, you've got a stacked buying imbalance, right? Normally, when you're looking at a stacked buying imbalance, it's going to be in a bar, a green bar, right? Because you have aggressive buying. Generally, what causes this is two things. One, a stop got triggered here, okay, and it poked higher, then immediately came back in, and generally it will continue moving in the direction of the bar. So if you have a stacked buying imbalance at the edge of a red bar, that's usually a pretty reliable short in the near term. It doesn't mean the market's going to move and sell off to new lows or anything like that. And if you have a green candle with a stacked selling imbalance at the bottom, it's the opposite. That's a nice near term, short term, long trade. And again, like I said, one, it's usually a stop getting triggered, or two, it's, somebody's just capitulated. Just get me out of this position. I don't care the price, buy me 50 at the market. Boom, they're done. They just wash their hands. They want anything else to do with the market. But it's a nice short-term reversal signal. So if you ever see those, it'd be a red candle with a stacked buying imbalance at the top, or a green candle with a stacked selling imbalance at the bottom. Um, I don't have an example of a stacked selling imbalance in the green bar today, but this was one I remember seeing this morning, and I just sort of threw it in there just to, show you, if you're looking at a footprint chart, that's something that you can take an active trade on. Now, we talked about, sort of understanding where you are in the market relative to the day's high, the day's low, multiple imbalance reversals. The third part I want to talk about is a very important part of trading, not just with order flow, but when you get into a trade, always look for the immediate follow through in the order flow. Now, most order flow traders are short-term traders, day traders, in and out of positions, in a quick period of time. It could be anywhere from a minute to 15 minutes. Very rarely will they hold things over an hour. But if you're using a range-based chart, when the markets were much slower under in 2015, 2016, it wasn't uncommon to be having S&P ranges of 10 points, 15 points for the entire day. So holding a trade for an hour really wasn't out of the realm of things. Even if you're trading on a night session, you could hold the trade for a bit longer. Now, what do I mean by immediate follow through is, if you don't know what other people are doing until they do it. And last thing you want to be stuck in a position is you get long, and then some joker over at some bank, you're long 3 S&Ps, but then some guy at Merrill Lynch is all of a sudden gets an order to sell 500. So what's going to happen is you're going to get run over, right? You want to put yourself in a position that the market is going in, right? And the best way to describe it is, if you want to be in a trade, and you want it to be moving in your direction as soon as possible, right? Like, you're not going to win the Kentucky Derby by getting into the starting gate backwards. Once the starting gate opens, if you trip, you fall down, you're not going to win the race, right? You're going to struggle to, keep up, and you'll just be happy to finish the race. So you got to remember what moves the market. Well, other traders do, right? With more money, and it's the traders that have big, deep pockets that, when those traders start flexing their muscle, that's what's going to move the market. And there's no one, I don't want to say one group of big traders. You obviously got hedge funds, obviously you got real money accounts, it's like central banks, you've got commercial traders, you've got hedgers. Any one of those groups would fall under you know other traders with more money, big traders. I don't like to use the term institutional traders. I think that's a term that really gets thrown around a lot when, there's big local traders out there. There's guys that routinely flip, 1,000 e-minis at a time. They don't consider themselves institutional traders. They're just big traders. Now, once you're in a position, right, you need those other traders to have the same directional bias as you. If not, what do you think is going to happen to your position? Well, you're going to get run over. My kids love, I don't know, watching these videos on YouTube of people just driving over things, like squishies. And, traders, you're going to be the same way, right? If you're looking at a position, you get into a position, and there's a big trader that all of a sudden, hits the buy or sell button opposite to you, you're going to get run over. So how can you tell? Well, how can you avoid is you let the market tell you. And how do you do that? Well, you have to understand, okay, one, where are we? Okay, are we trading in a range? Are we at a high or are we at a low? And for me, when we're stuck in a trading range, right? like here, we're basically trading sideways. Okay. Like, and I get a nice bar, a nice big green bar with multiple buying imbalances. Oh, that's a nice bullish bar. It's stringing together positive delta. That's also bullish. Points of controls all moving higher. That's bullish. I get long. The next bar, nothing happens. It's an inside bar. All right. Now, for me, this goes back to even before trading with order flow. And I noticed that a lot of my trades that I struggled with after I would get long or short, if the next bar was an inside bar, it could be generally what causes the inside bar is no follow through, right? There's nobody else sees what I see, right? Or nobody else thinks this market is going to go higher. And then the market just sort of goes into a tight range. Inside bars tend to be very small range bars, but it's indicative of market sentiment. Nobody's really interested in moving this market up or down at this point. So if I'm long and I see an inside bar, that's my first clue that this market isn't going to be moving in the, it might eventually go up. It also might eventually go down. I want to see the market make its move sooner rather than later. And the inside bar to me is sort of the first clue that this market isn't moving. Now, there's other clues in the order flow. So, for example, right, this is the chart I showed you earlier of the bonds, right? I've got my nice stack selling imbalance, nice multiple buying, selling imbalances is here. I've got my sweeping action. The next bar is down, right? So if I'm getting short off this, what I'm looking for is, is this market moving in that direction? And how do I break it down is I look for price action in the following bar. So if this bar here at 109 in the afternoon, the bar with the red arrow with the stack, the multiple selling imbalances, I see the low here at 181.29. If we can't break the low of this bar, that's also a sign to me that this market isn't going down. The last thing I want to do is get short immediately, at 181.31, and then the market just goes sideways on me. And then eventually, it may go down, it may go up. But as you get further away from your entry bar and the market's not going anywhere, the reason for being in the trade sort of starts decaying, right? It starts drying up, right? Because the reason for it selling off is obviously the aggressive selling, the aggressive seller as well with the market sweep. And I'm looking for that continuation. So if this bar doesn't even break the low of the signal bar, I'm not interested in that trade, right? And you can see here, we broke it, we started going down. Now, on the previous chart, right, if I'm getting long off this bar here, right, I'm looking at the high of this bar, 183.09. We can't even get up to the high of that bar. All right. So if we get up to 183.09, okay, there's buyers coming in, right? The market is continuing in that direction. The market can't even get there. This trade is not going to work out, right? And you can see inside bar can't even break the high of the signal bar. That's not a trade that I want to be long in. Now, here's another example, okay? And so you got your nice, nice bar here with your, you got your swing high, you've got the multiple selling imbalances. The next bar, it's an inside bar, and it's an inside bar. You can't even break the low of the signal bar, right? So what do you think the market's going to do? Is it going to sell off? Well, eventually it did, but as a trader, I don't want to be short here at 184.11 and take heat, all the way up to 184.21. 10 ticks of heat. I'd rather be. I'd feel more comfortable if the trade starts working out, right? So this is not a trade. This first trade, I'm not really interested in. The second time it happens, you got your stack, your multiple selling imbalances. Next bar starts breaking down. Okay, we got through the low at 184.06. This bar pulled back up to the point of control. From the low at 06, it pulled back to 12. If I'm getting short, imagine I'm getting short here at '06 or even '05, I'm taking slightly less heat than here. I'm taking, 10 ticks of heat. And every time a trade is against you, then you start expending a lot of emotional capital. Everyone's, oh gosh, get out. I know a lot of people get short here immediately. They sell the low, it starts taking heat. Gets up, it's 10 ticks. I can't take it anymore. They get out, they buy the high here, then the market reverses and starts going down. Right? That's the roller coaster that a lot of traders do because they're not used to um, taking heat. Nobody likes a trade to go against them. And when it starts going against them, people start wondering, should I get out of this trade or not? And oftentimes people get out at the worst possible price. And then what happens? The market immediately starts going in your favor. So it's more um what the term is, more easier on the mind, peace of mind when the market starts moving in your direction, you know, after you already decided, yeah, I should be getting short, right? Okay, I could be getting short here. Now I'm going to let the market tell me. I'm going to see the other traders also falling in line, also getting short. I'm fine to take, 6 ticks of heat because I already know that, the market's probing down. We're sort of coming up around this point of control here. Markets often pull back to the previous point of control, and then market makes its move. Okay, so here we are. We're at the low of the day in the bonds, right? Again, you got some nice buying opportunities here. This was a bullish prominent point of control. That's what this blue point of control in the bar means. Next bar, again, you test the low, inside bar. Okay, so if I was long off this bullish prominent point of control, inside bar, test the low, test that point of control. I'm not necessarily liking that long, but then the aggressive buying comes in. You got multiple buying imbalances capped off with a stacked buying imbalance. Next bar up, next bar up, keeps going up. Now you've got a red bar here. Okay, you got stack multiple selling imbalances. It's not a stack selling imbalance. You got 115, then 19, then 20, then 81. But then, so at this point, you're long from somewhere down in here, around, I don't know, 178.01. Next thing you know, you're trading 11 and you get a bearish sign. Well, should I stay in this trade? Should I get out? Well, you have your bearish signal here. It's a potential bearish signal. You got your multiple selling imbalances. Now, for me, what would be the key, that say stay in or get out is what's going to happen in the next bar. Okay. In this case, the bar stayed inside. Okay. Which is telling me, the selling is probably over, right? Because if the selling was going to continue, the market would probably start trading lower. In fact, the market closed up off its low. And then the next bar, it rallied. We can't even break this low of '07. So for me, even though I have, a potentially bearish bar here with the bearish prominent point of control with the multiple selling imbalances, I don't see any follow through in the order flow to tell me to get out of this trade. Now, in this case, right now, I haven't really talked about these points of controls today, but these, when you see blue points of controls, that's what I call a prominent point of control, and generally it's going to act as support if it's blue, just as if it was a red point of control, that would be resistance. Now, on a trending market, generally resistance levels and support levels, the market just often blows right through it. So if you're trying to buy, a potential support level and the market's trending in a direction, trending down, you're going to just get run over. And again, this comes into the whole concept of what's happening in the order flow to tell you that, yeah, maybe we've hit a support area or not. So, starting at the first bullish prominent point of control, next bar is an inside bar, right? If this is going to be a support area, I'm looking for a market to rally. And if the market's not rallying in the next bar, what, chances are it's going to break down. Breaks down, we get another bullish point of control, another potential support area. Then the next bar, another inside bar. It can't even break the high of the bar that I'm looking at as support. Next one, same thing. Another inside bar, can't even break that high. Now we get down here, we have a point of control on the extreme. You see the 326 here, right? That's decent volume at the bottom of the bar. Next bar starts going up. Okay, potentially can go higher. In this case, the market just went sideways, 1, 2, 3, 4 bars before breaking down and going lower. So out of 1, 2, 3, 4 trades here on this move down, there was no reason to buy the support here, no reason to buy support here, no reason to buy support here. Here, yeah, the market showed you potential buying, but even if you're watching the order flow, you just, one contract trade here, 16, 3, and it can't even, for the market to go up, you need aggressive buyers. You need people lifting the offer. If you only see one contract trade on the offer, you see 3 contracts trade on the offer, and the market keep going down, that's probably not a good sign. Again, that takes understanding, reading the order flow. More importantly, you're seeing the deltas on these bars as negative. So I know sellers are still in control of the market. Now, if this red bar had a positive delta of 43, then the next bar was a little higher, instead of one negative delta, it had a positive delta, it would give me, a little bit more confidence in the market. Then, you get another area of potential support down here. Next bar, inside bar, can't even break that high. Right. So, these are the signs that you got to be looking for in the market, right? I mean, trading order flow doesn't really put you in a box that you can't use any other form of analysis. Excuse me. Now here's crude oil. Again, we hit a swing high. No stacked selling imbalances here. Instead, you got multiple selling imbalances. You got 4 selling imbalances. Now, again, if you're looking for stacked selling imbalances, you won't even find any trades on this chart. But if you're looking at multiple imbalances, you're going to see a nice short here, right? Then the next bar starts, it opens up, trades up, starts coming off, right? Goes down, 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 down. You got multiple buying imbalances. Okay, well, maybe this market's going to start rallying again. But then you go inside, right? So if you're short, you can stay short. You don't have to get out yet. Now, you could read other things in the order flow, like the points of control, the fact that we're staying below the point of control of this bar with the selling imbalances is also bearish for the market. Excuse me, I need to drink some water. Then, so if you're short, you see this bar with the buying imbalances, you don't have to get out because you're not seeing any other follow through coming through. Instead, you're just seeing people, they could be taking profits. You don't know what they're doing. Then you see another bar with multiple selling imbalances, inside bar just goes sideways, but you should already be short from earlier, right? At least it's sort of trending down in your favor, in your direction. It doesn't look like much, but this is, about a 30 cent move here. So, excuse me. The easiest way for me to tell, the easiest tell for me, there's 2 ways to say it. Tell is, if you play poker, the trade is going to struggle is the very next bar. The bar immediately after entering the trade is an inside bar. It's probably not going to work out. Okay, you hit your low of the day. You got your multiple buying imbalances, a nice stack buying imbalance. Everyone's all excited. Hey, there's a stack buying imbalance. Next bar inside. All right, you're trading mostly below the point of control. Again, that's also bearish. You make a new low, start rallying up. You got a nice stack buying imbalance. You got 2 other buying imbalances down here. Next bar, it's an inside bar, but the next bar goes back up. I have a rule. I call it 2 and 2. Right? I look for over the next 2 bars, the market's got to move in the direction, and it's got to move in that direction of the signal bar high, up by 2 ticks or down by 2 ticks. If it can't do that, I'm not interested in the trade at all. Now, people say, well, you're going to cut yourself out of trades. Well, I'm also going to cut myself out of losing trades, right? I'm not going to take this long here because over the next 2 bars, we haven't moved higher. then the high of 2 ticks, this trade I would have been in, right? So I'm cutting out losing trades. That's my, everyone talks about risk management, managing your risk once you're in a trade. But I always say you got to manage your trading before you get into a trade. So, here's a nice multiple bar with multiple selling imbalances. Next bar immediately starts trading lower. You break the low by 2 ticks. Boom, nice move down. Next bar, prominent bullish point of control. Next bar immediately up, right? You got 1, 2, 3 buying imbalances, multiple buying imbalances there. Okay. But really, obviously, if you know anything about candlesticks, you'd say this is a nice bullish bar. It is. Obviously, your point of control towards the bottom adds another positive thing to it. Then you see a red candle with a bearish point of control, but the next bar is inside. Another bar, bearish point of control, starts coming off. Okay. So if I was long off of this bar, I'm long from here. The fact that I got this bearish point of control tell me to get out of here. So you just get out with your small profit. Market just goes sideways on you. Eventually it does poke higher, but I'm fine. I'm fine to just book that profit because at this point, I'm seeing some bearish signs in the order flow. Market starts trending down. In this case, market went sideways 1, 2, 3, 4 more bars. Okay, fine. I'll just wait for the next trading opportunity. All right, and that's you don't want to marry yourself to a position. Now, again, we hit our low here. This red line is the low. Start rallying up. You got your multiple buying imbalances here. 1, 2, 3. Next bar, okay, confirms me on that trade. Then the next bar is inside. So if I'm long, right? If I'm long in this next bar, say from 33.20, then the next bar afterwards is an inside bar. It's not looking good. And then the next bar starts coming down. I see a stack selling imbalance. This is my clue to get out, right? A lot of people will get long here and they'll get long at 33.20. They'll put in a stop, whatever, call it 10 cents lower, 33.10 here. If I'm reading what's happening in the order flow, I see, oh my gosh, I got inside bar. Next bar is coming down. We're trading, 33.13, 33.15. I got multiple selling imbalances. I can choose to get out of that trade. I don't need it to come down all the way to my stop level to stop me out, take a full loss. I'm fine to get out of the trade early if it's not working out with a smaller loss, 6 tick loss than a full 10-cent loss. Or, say you're using a 15-cent stop, that would put you down here around 33.05. You would have gotten stopped out at the full loss, but by reading the order flow, you should have gotten out, anywhere between 33.10 to 33.15. Now, we'll just deal with this stack selling imbalance in here, right? So, you hit your swing high, you got a little sweeping action in here, some aggressive sellers coming in. Next bar, inside bar, right? You haven't broken the low of this signal bar. That's not a good sign. Obviously, the bar trades up. Again, not a good sign. You got positive delta. These are the trades you got to stay out of, right? Just because you have a signal, this is where a lot of people that trade with indicators go awry, is they think, I got a signal, I got to take it. Well, let the market tell you whether you should take it or not, right? And if you just take any blind trade, then you're really going to be stuck oftentimes on the wrong side of trades, on the wrong side of market moves, and especially nowadays, right? The market's extremely volatile and the moves can happen very fast. So that about wraps it up. There's people. There was a guy, he emailed me about a week or two ago. I forgot his name. I accidentally deleted his email and I haven't been able to recover it. He told me he attended the last time webinar, but I haven't been able to find the email and I don't know what happened to it. I think I accidentally deleted it, but if he's there, you can just email me again. Now, Tom always asks me, hey, can you get a special deal? I got a deal for you guys, okay? And it's my normal deal, right? It's the orderflows.com special, right? Which is the order flows trader software. You get two indicators that help you read the order flow, right? Because a lot of people they're interested in order flow and they think they're going to adapt and start reading it. But I include two additional indicators. One's the pulse and one's the turns. The pulse looks for additional sweeping action in the bar. The turns looks for order flow that's acting as support or resistance. And with this special, normally you get two of my courses. You get my order flows inner circle and my basic order flow trading course. The order flows inner circle is a lot of good stuff in there. That's like years ago, I wanted to create something that, when if my kids ever have interest in trading, they can go back and refer to. There's about, I forget how many videos, 56 videos in there on different concepts of order flow. But for most of, I find traders that have an interest in learning do better than traders that have an interest in buying indicators. So I've got one, two, three, four, five, six, seven other courses. Now, I don't expect everyone to go through everything in a weekend. You got to go through everything in your own time. But this is about I don't know, maybe about 30 hours worth of additional training in here. So I'll give you access to my advanced order flow course, the order flow playbook, which I think is probably my best course that I've ever made. Um, the absorption course, so you can understand when the absorption is present in the market. That's the one nice thing about order flows. You can see things like that. I have more in-depth training on points of control, delta, and imbalance. And the Trader Kickstart deals with the mental side of trading. It's funny because I know some other guys that teach traders, and they always say when I make a, they talk about how they make a video, post it up on YouTube about the mental side of trading. It always gets the lowest view count, but if they put up videos with a lot of charts and everything, it blows away anything that has to deal with the mental side of trading. Yet it's very important aspect of trading, being right mentally. Now, this is a special offer for Tom's guys, so this is not, I don't put it out there for anybody else. And if you purchase it, just shoot me an email so I can get you hooked up with those bonuses. And the thing with order flow, there's a lot of different little nuanced parts of it. I'm talking to a guy right now. He's really sort of building his whole trading plan around points of control. Right? I know other people that build a whole way that they trade around imbalances, and I know other people that use mainly delta. There's so many different little parts of order flow that you could really build out from and understand the market from. So, I told you earlier, right? A good place to start is go to my YouTube channel, but another good place to start is, get my book, download my book, right? Just go to orderflows.com/book.html. It's 150 pages. You just got to enter your name and email address. And then after you hit submit, it takes you immediately to the PDF. You can save it to your computer. But that's really the best way to get started is obviously my YouTube channel, obviously my trading book. And again, if you really want to take your trading to a next level and understand how you could apply order flow to what you're currently doing, um, I think that special deal is the best way to get started. So, Tom, if you're there, if there's any questions, I'll be happy to take them.
Yeah, there were a couple. Oops, sorry, had my microphone up.
Okay.
There was a question earlier. Does one buy sell based on previous candle order flow? I think you kind of already talked about this. You're not looking at just one candle.
Yeah, I think you got to, you take it in context of what's happening, in the market. Sometimes, you know, it, it starts with one candle. I think then, you sort of got to watch, put it in context with what happened before and what's starting to happen immediately afterwards. So, it's not just one candle in isolation.
And then Thomas asked, do you have any statistical study supporting your analysis?
I don't have like a spreadsheet where, it says, this formation shows, 98% win rate or anything like that. Because you got to realize, markets trade different types of volume, and different types of volatility. So, for something, an analysis like that, I think it's difficult because looking at the markets, the last 3 weeks compared to the last, the 3 weeks before that is very different in the volatility, and even this last year compared to a few years ago is going to give you very different numbers. There's a type of analysis in order flow that's called unfinished auctions, all right, which is, if you have like a bar that has, a green candle, at a that has, a bid on the top volume, on the top bid side, volume on the top bid side. People call that an unfinished buying auction, and they'll look for the market to come back. Now, the people, in the early 2000s that really started noticing that, they did that when the markets were, trading in very tight ranges, and the markets would often, come back to those levels. But then as the markets grew more volatile, it didn't. All right. So, sometimes, there's a saying, you trade what works until it doesn't. So, markets are dynamic.
Iggy asked, what about trading in high time frames like hours? Is there a difference in the higher time frames versus the shorter ones?
Well, yeah, there is. There's, honestly, when you're dealing with order flow, you're dealing with what's coming into the market now. And, looking at on an hourly basis, trying to put together, say, an hourly footprint, what happened 50 minutes ago, chances are isn't necessarily relative to what's happening right now. Now, there are going to be cases where there is something interesting, but, like what I call a small print or a thin print, or maybe big stopping volume, at a particular swing high or swing low. But in general, it's data that the most value is in the near term rather than over the long term.
So is there a maximum time frame you'd use order flow with?
For me, I don't really look at anything over 30 minutes. I have a friend in London who he comes from a market profile background, so he's used to looking at things in 30-minute time frames, and he likes looking for these a certain thing happening in the order flow on on a 30-minute chart, and he'll draw his levels out from there, and he's willing to wait. It comes down to your own style of trading, and me, I don't necessarily have 8 hours a day to sit in front of a screen and watch for a level that happened 3 hours ago, into the future. So nowadays, my trading has changed a bit more to a shorter time frame, but there are people that use it on longer time frames. Definitely not over a day, unless it's a level that you're drawing out on a 30-minute chart. But
Oh, and
that's different.
Thomas asked, do you know the math meaning of random? He thinks he has the answer already.
The math meaning of random. I'm not sure of that question. um,
Yeah, maybe you could clarify a little bit, Thomas, or maybe you have your answer. I don't know.
yeah, why don't you share it with us?
Well, we're kind of over time anyway,
Yeah,
so maybe
you can shoot me
Thomas,
an email,
yeah, just
and
send Mike an email, and
it's my
maybe
email
can.
is there. It's Mike at
Okay, great.
orderflows.com. Yeah.
All right, well, thanks very much, Mike. All's interesting. I'm really fascinated by these footprint charts. I've never used them before until recently, and I'm really enjoying them. You definitely see more than just a regular candle.
Yeah, I mean, it's a tool, right? It's not a holy grail. It's a tool to make market understanding easier. Um, just as a carpenter has different tools for different things. A trader needs different tools for looking at the markets, right? A footprint chart is one way. Obviously, it doesn't mean you got to throw out everything else you've learned in the past. Uh, you know, I find that some of the best traders that deal with order flow, you know, take what they've already know, apply order flow to it, and they just find that their entries are better, their exits are better, right? And ultimately, that's what it comes down to, is making improving constantly.
Absolutely. All right, Mike. Well, I'll let you go. Thanks everyone for coming. I'll get this posted on our our YouTube channel and our members library as soon as I can. And have a great day. Hopefully the markets treat everyone well. And yeah, well, I'm sure we'll have you back, Mike. So
Okay,
thanks so
great.
much.
Thanks a lot, Tom. Have a great day.
You too.
Bye bye.
Bye.